Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, December 13th, 2022. Welcome back to the podcast, George.
Great to be on, John.
Always good to have you. So, George, we have finally, at least I hope we have, finally collectively made it to what will be in all likelihood the last market moving events for 2022. In separate conversations, you described this as the last key week of the year, also as the last vol window where markets can and will, react to market moving events, perhaps more than usual. And here we have the last economic data and the last central bank activity of the year. So case in point, we just had the all-important CPI report, which, as our listeners know, came out really universally softer than expected. We saw a pretty big reaction in the market. Looking at my screen, I see the 10-year Treasury about 10 bips richer on the day. But also, back to the data itself, not only was there downside in the headline, but there was a softer core reading as well. So I suppose the question is, what are your thoughts on the report itself, as well as how financial markets have reacted?
No, that's right, John. So we've made it to at least the some version of a finish line, and I do think today's CPI report is important. I mean, at least in the short run, it's corroborating this idea that we've probably seen peak inflation for this regime, most likely, at least in terms of the bigger categories within the CPI basket. It's going to be hard to reaccelerate unless we get some sort of shock from the energy sector. But because knowing what we know now and with the benefit of hindsight, most likely we've seen the peak, at least in the short run, for this cycle of this impulse higher in inflation. Doesn't necessarily mean that inflation has to and will go back to the Fed's target. There's still a lot of work to be done, and it's unclear if we end up getting again one of these shocks along the way. If energy were to kind of rise up for either supply constraints or geopolitical tensions were to worsen in 2023. It's quite possible then you can get another round of inflation, and also with China now trying to reopen or their version of reopening, it's also possible that we can get an inflation impulse from that side too. So although we've probably seen the highs at least for U.S. inflation on the headline, core has been stickier, although also weaker than expected today too. Core, some of the bigger categories there, especially the owner's equivalent rent, is proving to be a little bit more stubborn to head lower. But also, just given what we know in terms of rent trajectories, that too should also come down. So, by and large, we should be anticipating a lower inflation backdrop over the course of the first 6 to 9 months of 2023. In many ways, this is the fait accompli of a lot of the impacts from the pandemic are starting to work their way out of the data. Both the like for example, used car prices are starting to head lower in the right direction. There's less supply constraints. Production is picking up, but also the economy is slowing, and so there's less demand for big durable good items, and so we're seeing some relief on the auto sector in terms of inflation. Even apparel, again, the energy side was a big driver, and that has basically come around full circle. So we're seeing a lot of this, pandemic type, travel also is seeing some reduction in pricing pressures. So we're seeing like the pandemic induced inflation work its way out of the system. We're heading to a much more normal or quasi-normal type inflation backdrop. But still, there's a lot of sticky inflation out there, and it's not clear that it's going to completely go back to the Fed's target. And core services, although also heading in the right direction, still is elevated, and then that causes concern for the Fed. And so I think, again, 2 weak months in a row is starting to form a trend. Peak inflation is likely behind us. The pandemic-induced inflation also probably behind us too. And now we're moving more towards a steady state. We just don't know if that's going to be 4% inflation or eventually down to the 2% inflation that the Fed is mandated to deliver.
That makes a lot of sense. Okay, so just to summarize, we're probably past peak inflation, but I think it's too as you it seems like you're saying it's sort of too early to write it off, as there are a number of uncertainties, and you mentioned that the future state of inflation could be, we don't know where that's going to be. Are we going to go to the low inflation regime we experienced prior to the pandemic, or perhaps something higher? As you know, we were up in Toronto and Montreal visiting clients last week, and that was certainly that was certainly one of the topics of interest. What does inflation look like? Are we entering some sort of new normal? So great. That was it
Sorry,
was
yeah.
Go ahead.
One thing I forgot, just to kind of interject and keep this interactive, I forgot to mention the market's reaction. And so the market's reaction was interesting, especially because these numbers come out before the market opened, but rates markets are trading already. The initial impulse higher, big gap open on futures, and although the market, at least the risk market, gave back some of those gains and it's climbed back into the close, it didn't finish on a strong note. And so we had a really big rally in risk assets on the Monday before the CPI release, and now with CPI data and the market's reaction before the Fed, it does feel like there's a little bit of kind of a more defensive posturing, that maybe a lot of gains have been pulled forward, at least for risk assets. Meanwhile, the rates market is now pricing like the Fed is done and about to enter into an easing cycle. So I think both of those two things are a little bit too premature.
Yeah, absolutely. I'm glad you added that. So I think that was a pretty comprehensive discussion of the CPI report and inflation going forward, as well as market reaction. Let's turn to the other main event of the week. As a reminder for our listeners, we are recording this podcast on Tuesday, December 13th. Anecdotally, during the Argentina-Croatia World Cup game. So if you have some ambient noise in the background, my apologies. But also a day before the last FOMC meeting of 2022. George, why don't you take our listeners through what to watch for during tomorrow's FOMC meeting, as well as your expectations and the risks to that base case?
Absolutely. So tomorrow, the kind of the capping stone for what has proven to be the fastest hiking cycle in a 1 year window, especially for the Fed going back to the 1970s. I mean, this cycle already overtook the 94 to 95 cycle, which was the prior fastest cycle within a 1 year window. And now, the Fed, if they deliver, which we think in the market basically agrees with, a 50 basis point hike tomorrow, the all-in travel is about 425 basis points in 1 year. That's a lot of rate hikes, cumulatively speaking. So we'll get the last 50. Well, the Fed will be moving from a 75 down to a 50, which is notable, but we will be getting still a large hike nonetheless. So 425 bips delivered in a 1 year window, impressive. Yeah, I think beyond just the movements and the adjustments in rates, this is also a quarterly FOMC meeting where they'll have the updates to their economic projections, both for inflation growth and their interest rate forecast, which is infamously known as the DOTS forecast. We've heard Chair Powell, as well as among other Fed speakers, say that perhaps the last economic projections were too low, especially for the rate projections. They had a 4.63 as an upper bound at the September meeting for the terminal rate for Fed funds. And all along since September and November meeting, we've heard many Fed speakers say that the ideal rate probably is closer to 5% or higher. So I wouldn't be surprised to see the rate projections at least move in that direction. We know, again, the CPI was softer today. It's understood that the Fed participants and forecasters can adjust these forecasts up until the last day of the meeting. So it's possible that they can tweak it, but nonetheless, I think a 5 handle somewhere in the median rate projections is what we should expect as a base case. If we don't, then that would be considered dovish. In addition to that, we'll see updates to their core PCE as well as PCE inflation estimates for 23 and 24. What do they do in terms of that? Do they nudge it higher? Do they kind of stick with what they had initially put in place in September, which was already an uplift from the June projections? Do they kind of keep it the same? That would maybe be considered dovish, or do they tweak it higher? Just because we still don't know the end point for this inflation. And then, of course, GDP. I mean, the biggest and the unemployment rate, the biggest inconsistencies throughout this whole time period, at least from market participants like myself, is just the idea that the Fed can engineer this soft landing without really resulting in a higher unemployment rate, nor take a hit to GDP. So we'll see how they project that as well. Chair Powell then will go into the press conference, and in all of the press conferences since they started to really take inflation serious earlier in the year, there's almost like a public service announcement about how inflation is the main focus. As long as that is how Chair Powell opens up, then that's consistent with all the other messaging that we've heard throughout this campaign against inflation. If for some reason he starts to kind of pivot or start to kind of shift more towards equally being concerned about the growth outlook and inflation, and then this would qualify as a pivot. I don't think he's going to do that yet. I think he's going to probably, I think the overall FOMC is going to reserve that for the February meeting to see how the start of the year looks like. And, by then they're going to be even higher in rates, and they can then start to really signal that they're going to go to a pause. But that's something to watch out for. The PSA and their focus on inflation versus growth, what to do with the dots, get us close to 5% or higher, and just an overall message that they're not done yet, and that they're closer, but they're not done yet. I think that would be like my base case. Short of that, I think it will be construed as a dovish kind of message. Then we get into the Q&A. And as we've seen, Chair Powell do already twice in a row, both at the September meeting and November meeting, that's when he really pushes back. And we've had a 50 plus basis point rally in rates since the last meeting. We've had an 8% move in the stock market. Financial conditions have actually eased since the last Fed meeting in a very significant way. So if, in the Q&A and just over the course of the discussion, there's a pushback by Powell, then I think that will be another kind of example. They think financial conditions have moved too much. That's what I'm looking for. I think that my base case will be kind of delivered. We'll see. But the risk is this market is always looking for dovish signals. And so if they pick on something, the market can run with it. The question is there follow through?
Yeah, as I recall, I was surprised during the November FOMC that he didn't kind of mention financial conditions, and that was one thing that how they had eased, and that was one thing that the that the bulls kind of held on to. So it sounds like that's sort of similar case here, for the December meeting.
That's right.
Okay, great. Well, for more, I would definitely encourage our listeners to check out George's FOMC preview. It will be out. The morning the podcast drops. And if you are not receiving George's strategy reports, please do get in contact with George directly. Great stuff as always. Thanks again.
Thanks, Chuck.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.